The stock market is more expensive than it's been since the height of the dot-com frenzy, but it's not the only investment bubble ready to pop. Trillions of dollars pushed into the economy by the Federal Reserve and governments around the world have taken prices to dangerous levels. If you're not protecting your money, you could see it vanish in the next big stock market crash. I'm Joseph Hogue, your bowtie believer, and these are the 3 stock market bubbles ready to pop. The coronavirus literally shut down the global economy, with more than 40 million Americans filing for unemployment. In response, the government and the central bank have forced more than $6 trillion into the economy. To put that into perspective, it's more than 18,000 pumped into the system for every man, woman, and child in America. The Federal Reserve, the nation's central bank, has pledged unlimited financial asset purchases to support the market. The bank has lowered interest rates to 0 and even started buying the bonds of junk-rated companies. The central bank, the agency tasked with guiding America's monetary policy, is now buying the debt of companies that may not be able to pay it back. Was this extreme level of stimulus needed to keep the economy from falling into a depression? Absolutely, but that doesn't mean there won't be consequences, and those consequences could destroy your investments if you're not ready. Anytime you force that much money into the economy suddenly, it's going to create bubbles. Even with tens of millions of people out of work, more than 100 million plus are still collecting a paycheck, and most companies are still operating. The extra $600 weekly unemployment payment through the $2 trillion stimulus program means some people are making more money on unemployment than they were before the crisis. And with spending shut down, the personal savings rate surged to an all-time high of 32% in April, more than 5 times its average. Americans are saving 1/3 of their income, and it has to go somewhere. It turns out that money is going into investments like stocks, bonds, and real estate, pushing up the prices of these assets to record levels. The problem is, when the government turns off this artificial money machine, when it stops forcing trillions of dollars into the economy, and these investments could crash back into reality. The US economy, when it functions normally, creates about $500 billion of wealth each year through wages and business growth. Imagine what could happen when, instead of pumping $6 trillion into the economy, it's only creating that $500 billion. That means more than $5.5 trillion is no longer propping up investment prices. With that in mind, here are the 3 stock market bubbles that could be about to pop and what to do to protect your money. The stock market has surged 44% from the low on March 23rd as lockdown investors pour money into hot stocks on platforms like Robinhood and Webull. With corporate profits expected down more than 35% in the second quarter and 22% for all of 2020, that means stocks are more expensive than ever on a price-to-earnings basis. The massive bond buying program by the Federal Reserve has forced interest rates to 0. That means investors are pushed into stocks and any kind of a return, and drives share prices higher. Trillions of dollars from the government stimulus has also found its way into stocks, and ultra-low interest rates means companies can easily borrow billions in essentially free money. But if you look at a chart at the S&P 500 stock market, the blue bars, and the quarterly growth in the economy, the orange bars here, there is usually a direct relationship that even a 4th grader can understand. As the economy grows and corporate profits increase, the stock market rises. But that relationship has totally broken down, with trillions of dollars flooding into the market. Stock prices surged in the second 3 months of the year, even as earnings plunged. For all of 2020, Wall Street expects corporate profits to fall 22% from last year and barely recover in 2019 level through 2021. All this means stocks have become historically expensive, with no real economic growth to justify the increase. The last time stocks were this expensive, back in 2000, tech stocks in the NASDAQ plunged 77% and didn't recover their peak for 13 years. What can you do to protect your money from the potential apocalypse in stocks? Don't forget bonds and real estate as a part of your portfolio. Adding 15% of your money to a bond fund like the Vanguard Long-Term Bond Fund, ticker BLV, or the iShares US Aggregate Bond Fund, ticker AGG, is going to protect your money and give you the opportunity to invest it in stocks when they do crash. Putting another 20% of your money in real estate funds like the Vanguard Real Estate Fund, ticker VNQ, or individual real estate investment trusts like the Digital Realty, ticker DLR, gives you the cash flow of property and the protection from roller coaster stock markets. Another market bubble is inflating in corporate bonds, and this one could lead to a wave of bankruptcy or just limit economic growth for decades. The second quarter of this year was the busiest ever for companies borrowing money, with over $587 billion in bonds issued and over $1 trillion in the first half alone, also a record according to the Securities Industry and Financial Markets Association. In fact, corporate borrowing in the first half alone was greater than 16 of the last 19 years. Easy money for borrowing may not sound like a bad idea, but it's created zombie companies being propped up with that cheap money. These companies wouldn't be able to survive without that free money and 0% interest rates, but are able to hobble along with the help of trillions from the Fed. At best, this means lower economic growth as inefficient companies not making money are kept on life support, and lower stock returns on those weak profits. At worst, if interest rates do increase after the Fed stops pumping money into the system, companies will find it impossible to repay that debt, and it could cause a landslide in bankruptcies. Protect your money by investing in the most stable companies, those with lots of cash and little debt on the balance sheet. To find this, use any investing platform to go to the company's financial statements and find the balance sheet. The report is also available on a company's investor relations page. Cash and cash equivalents will always be the first lines, and the higher the better here. You want to make sure that the company has the cash set aside no matter how bad the business gets. Then look for the amount of long-term debt listed about 2/3 of the way down the report. Companies with lower debt compared to their market value of a stock or large stashes of cash will have the flexibility to survive even if that bond bubble bursts. The stock market frenzy has spilled into the market for new stocks and IPOs. A record $184 billion was raised through IPOs in the second quarter, and over $8.9 billion that priced above the target range. That's the amount of share price surging over the open. It was the most since 2014 and a measure of bubbleness. Investors are paying sky-high prices for IPO stocks despite history showing these are usually lousy investments. Research of the University of Florida shows IPO stocks return an average of 3% less than shares of other stocks for years after the issue. Hot 2020 IPOs like Albertsons and Casper Sleep are already down 9% and 5% from their open just a few months ago. Now, protecting your money means being wary of any new IPO stocks and consider giving these shares a few months to cool off before you invest. Research on over 300 IPOs since 2000 shows the average price falls 5% just over the first 20 days of trading. When you do invest in a new IPO stock, never jump in with all your money at once. For example, if you're planning on investing $100 in a stock, invest $35 on that first day and hold the rest to invest after 3 months and 6 months. Click on the video to the right for the highest return investments ranked, 5 investments for double-digit returns. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.